Millions of people step into the trading world every year. For a beginner, a flashing green candle represents a path to financial freedom. Every breakout feels like the single trade that will finally pay off the mortgage or replace the monthly salary. A few months later, the story usually shifts. Trading screens go dark. A quiet realization sets in as most walk away, convinced they simply lacked the right technical education to make it work. This diagram illustrates the fix-it phase. A failing trader hunts for a holy grail in technical analysis, burying a simple price trend line under RSI, MACD, and Bollinger Bands. They operate under the assumption that more data points will eventually eliminate their losing streaks. If memorizing chart patterns and reading technical books were the sole requirements for success, every student of the market would be wealthy. The technical setups are only half the equation. The real conflict occurs within the trader's own mind. Trading is a psychological test of endurance. A strategy only functions as well as the person executing it under extreme pressure. An obsession with external market patterns often blinds a trader to the internal impulses that actually drive their decisions. Without a way to manage those impulses, the most sophisticated strategy remains at the mercy of a single moment of panic. A brutal loss strikes the trader's ego long before it hits their bank balance. It forces a confrontation with hidden fears and self-doubt that most people spend their entire lives trying to avoid. Trading psychologist Mark Douglas argued that the market acts as an uncompromising mirror. It provides a constant, real-time reflection of a trader's internal character, offering zero mercy for their personal insecurities. Consider the impact of impatience. When the market is flat and offers no clear setup, the simple act of doing nothing becomes uncomfortable. The trader eventually forces an entry merely to escape the anxiety of being inactive. Greed operates with similar logic. When a price moves favorably, the urge to increase position size often overrides the original risk plan. The trader abandons their strategy to chase a larger payout, right at the moment the risk is highest. This leads to a cycle of revenge trading and complacency. Success breeds a dangerous overconfidence that encourages rule-breaking. When the inevitable loss follows, the trader reacts with a desperate, emotional need to over-leverage and win back what was lost. A blown trading account represents the mathematical culmination of these unmanaged emotional outbursts. Each impulsive entry and revenge trade adds up until the capital is simply exhausted. This diagram shows the structure used by most amateurs. They prioritize profit chasing above everything else, leaving capital preservation as a tiny, unstable foundation. Eventually, the weight of the losses causes the entire structure to collapse. The most successful traders invert this structure. They secure their survival first. By building a massive, solid base of capital preservation and emotional control, they ensure that the small, stable peak of profit has something to rest on. This requires a shift toward quality over quantity. Constant market activity is rarely a sign of professional skill. It is usually a sign of an amateur who hasn't learned to wait for high-probability setups. Professional trading includes the decision to stay out of the market entirely. If the mind is clouded or the setup is weak, the most profitable action is to simply keep the mouse still. A trader who cannot defend their initial capital has no way to participate in the market's long-term opportunities. Protection is the prerequisite for growth. Sustainable success requires an identity shift. Amateurs try to predict the future. Professionals view themselves as risk managers, whose only job is to execute a strict process and contain the downside. Apply a pre-trade filter to every position. Ask yourself, if this hits the maximum stop loss, will it disrupt your ability to sleep tonight? A no indicates your position size is far too large for your emotional threshold. Discipline is built by tracking behavior, not just balances. This ledger shows the 5-minute journaling rule. It ignores financial numbers, focusing instead on emotional triggers, the impulses felt, and the actions taken. The blank spaces where profit and loss usually go force you to focus on your execution. Trading is a long-term marathon. The market's mechanics eventually transfer wealth from those who overtrade and panic to those who can remain disciplined over hundreds of setups. Tweak the timeframes or add new indicators as much as you like. Those changes remain superficial until you address your internal reactions to uncertainty and risk. Financial profit is the automatic result of a perfectly executed, repeatable process. Once you control your own impulses, the market loses its ability to control your future.